Hello friends, this is Vijay Bhambwani and I'm back in this video to talk about the markets with you using our unique in-house statistical tools which are simple to understand yet highly accurate. They've stood the test of time and they've basically guided us as to the market trends in the coming week. So let's dive right ahead and see. As last week I told you that the statistical weight of evidence was telling us that the bulls might have an upper hand and the Nifty managed to rise a little as compared to the Bank Nifty, which underperformed. So coming up on your screen is the market roundup window, which basically tells you that the Bank Nifty, of course, underperformed the Nifty due to the obvious reason. The Dixie, the US dollar index was high. Bullion fell because of this as well. And risk on sentiments. Risk on sentiments are when traders choose to deploy money in riskier assets as compared to safe havens like gold. Now, the US dollar rose against the rupee, which pressurized our domestic markets. Oil and gas prices rose, which is inflationary, and the 10-year benchmark bond yield rose 1 basis points, which partly explains the relatively weaker Bank Nifty. Partly. The market-wide position limits or MWPL chart on your screen shows a routine rise, which you'll see till the third week of September. Now, let's check the stock and index futures volumes, which are basically something that are raising a red flag. I'm seeing the stock futures volumes at the period low, the period being 20 days in question. Assuming that we give it a benefit of doubt due to the short week, and we'll basically get back to the other data to see what that is pointing towards. Even the index futures volumes are at 17-day lows. Remember, these are cumulative volumes of September, October, and November. So this is a minor red flag. Even though the markets were making a fresh all-time high, the volumes were not keeping pace. Now the basis chart on your screen, basis is nothing but the premium enjoyed by the future as compared to spot. So the basis chart on your screen shows a contracting bias where the basis is falling for the Bank Nifty, whereas the Nifty is actually inverted. By inverted meaning the future is trading at a discount to cash. This shows a selling bias, maybe by hedgers, maybe by short sellers, but a selling bias. So this is another noteworthy aspect to remember, which is a small, I repeat, small red flag here. Let's now go to a study which is basically one of the most reliable studies that I've shared with you, and I'm not just saying it because this is our in-house study, but past track record of the study has been very good. I'm talking about the impetus analysis, which you won't find anywhere else in the public domain. This indicator has raised a couple of red flags, not just one, but a couple of red flags, sharply lower for both the headline indices, which is the Nifty 50 and the Bank Nifty. And the implication of this study is that even if the Nifty gained on a week-on-week basis, the momentum was very poor. And can this reverse in the coming week? Yes, of course it can, provided the bulls come back and start buying proactively. But till that time, till such a thing occurs, do not venture out into aggressive longs. Because this week, I'm seeing a lot of red flags around. By red flags, I don't mean a crash indicator, but just too many worry points are occurring, and that is weighing on my mind. Now let's take a look at the footprint of various market players. The FIIs, the foreign investment institutions, have cut their index longs to 45,205 lots, which was earlier last week at 53,294 lots. They appear to be cautious here. They also reduced their stock futures longs to 3,05,500 lots from earlier 3,52,529 lots. The DIIs, or the domestic investment institutions, they continue to remain short. Their stock shorts were at 12 lakhs 83,702 lots as compared to 12 lakhs 83,091 lots, which means a little more increase in shorts on stock futures, whereas their index futures shorts actually went up to 86,121 lots from last week's 81,965 lot short. So the DIIs are not budging. Let's now take a look at the prop traders. Prop traders reduced their index shorts to 18,588 lots, which was earlier shorts of 24,615 lots. Their stock futures longs went up to 1,51,130 lots from a previous 1,28,416 lots. Coming up on your screen now, the retail traders, and these guys are returning back into a buy mode. Their risk appetite is increasing again. Their stock futures longs rose to 8,27,072 lots, which was earlier 8,02,146 lots. Their index longs hit a new period high at 59,504 lots, which was earlier 53,286 lots. Now the big question is, will the retail traders continue to do all the heavy lifting and manage to boost markets with their buying momentum? The coming 5 days will show us. I think 3 red flags by now should make us go cautious and trade light. I'm not telling you to stop trading. I'm not telling you to get bearish, but trade cautiously. Friends, let's now go to the 10-year benchmark bond yields, which have stayed almost unchanged at 6.17% as compared to 1 basis point higher of last week. The developments for our bond markets were robust forex reserves that India enjoys, and the possibility of our bond indices being included in international benchmark bond indexes. That can ease the liquidity issue for the Reserve Bank of India, which, remember, I've told you in my earlier videos, has to raise 12 lakh crores as per the finance minister's budget speech. We are already almost halfway done through the financial year, and this target will be something that will be have to be matched at double the speed. So far, we've seen banks which were the biggest bond buyers, but now with COVID-related moratoriums and waivers, they can't do all the heavy lifting alone. And besides, at 6.17% yields, I wouldn't expect them to invest in the bond market very proactively either. Therefore, if the Indian bond indices were to be included in the FII indices, their inflows could change the things around and help the Indian banking space. So, FIIs being more alpha-centric or sensitive to absolute returns, they may invest money, all other factors remaining constantly agreeable to them. Watch this space keenly in the days ahead. I'll be updating you here itself. Friends, now let's go to the Dixie, which is the US dollar index, which managed to defend the 91.5 levels that I have been talking about for days. Look at the daily chart on your screen. This currency benchmark index has risen on 3 out of 5 trading sessions last week. The range of panic and fear remains stuck between 91.5 and 93.5. The daily chart shows the price at the 25-day exponential moving average, which means it's finding equilibrium at these levels. The US debt ceiling and the inflation, rising inflation, is making the dollar volatile, as is the decision by China and Russia to deal in oil and gas between themselves in the Chinese yuan compared to the US greenback. The ripple effect is now being fed by hard assets, bonds, and equities the world over. Let's take a look at the weekly chart of the Dixie, which shows a bullish candle, which is contained within the previous bearish candle, which is a sign of relief for the bulls, though it is not necessarily a buy trigger unless follow-up buying takes the price above the recent high of 93.5. The price has taken support at the 25-week exponential moving average and rallied. The bulls must defend this level on dips to make the momentum and keep it alive. It's actually like riding a tiger. As long as you're pushing prices higher, the tiger is moving forward. The minute you try to get off the tiger will devour you, will eat you up. So last week, I advocated a range between 93.20 on the upside and 91.05 on the downside, which held. The coming week, I expect an estimated, I repeat the word estimated, range between 93.60 on the upside and 91.60 on the downside. I would watch the Dixie very keenly for the coming days for signs of trend determination of various asset classes. Friends, now let's move on to the Bank Nifty, which fell 0.21% last week and logged losses on 3 out of 4 trading sessions. The price stays above its 25-day exponential moving average, so the short-term outlook remains positive. But for now, the price is also above the 36,500 mark, which I had advocated in the weeks earlier. So far, so good. As long as the trajectory continues, the bulls may come to offer follow-up buying support. Now let's observe the weekly chart on your screen. The last candle was a bearish hammer. The weekly range was narrow and the previous week's high could not be surpassed. While some of it can be due to the short week, the red hammer needs watching. The week's low at 36,151 should be defended at all costs by the bulls in the coming week. And the price on the weekly chart is above its 25-week exponential moving average, which means even the medium-term outlook is positive for now. In the week prior to last, the index was number 4 on the most volatile list, but it shot up 3 notches to number 1 due to the extremely tentative and fickle intraday trades that we saw last week. High volatility is the 4th red flag, even though it's a small one, but it's nevertheless a worrisome factor. Last week, I advocated a range between 38,175 on the upside and 35,350 on the downside, which held. And the coming week is likely to witness an estimated, I repeat the word estimated, range between 38,050 on the upside and 35,325 on the downside. The Jensen's measure, which is a risk-reward ratio measure used by hedge fund managers, points towards the Bank Nifty being more volatile, more risky than the Nifty 50. So I suggest you continue to trade, but trade light and enforce your stop losses on long positions. Friends, let's now go to the Nifty 50, which gained 0.68% on a week-on-week basis and rose on 2 out of 4 trading sessions last week. The price remains above its 25-day exponential moving average, so the short-term outlook remains positive for now. What worries me on the chart are the sizes of the candles of the last 4 days. They're extremely small on all 4 trading sessions. Couple that with the falling impetus that we saw earlier in the chart, it tells me that the momentum is slackening very, very rapidly. Can it change? Yes, of course. If the bulls come back and start offering proactive support, things can change. But till that time, we need to keep waiting and watching. Are the bulls taking time off? or are they tired? The coming week will know. Nevertheless, this is another and the fifth red flag. Now let's take a look at the weekly chart, which shows a tiny doji on the chart. Now this again is the sixth red flag, a small one, but nevertheless, because this is not the size of a candle that I would want to see at an all-time high when the volumes are low, the impetus is poor, and the market breadth, of course, also was not exactly very great. If the bulls are to show an unmistakable up move next week, the bullish trigger will be to keep the Nifty trading above the weekly high of 17,436. Now, the falling impetus, like I told you, was a red flag. However, the price still remains above its 25-week exponential moving average, which shows the medium-term outlook is also positive for now. Last week, the index was at number 9 of the most volatile list, whereas it has basically fallen to number 12 on the most volatile list due to the narrow intraday ranges and the falling impetus, remember. Now, last week, I advocated a range between 17,775 on the upside and 16,850 on the downside, which held perfectly well because the range was too small to test the levels in either direction anyway. It was not going to happen. Now, the coming week is likely to see an estimated, I stress upon the word estimated, range between 17,775 on the upside and 16,900 on the downside. Trade light on the Nifty as well because volatility and the spreads between the bid and offer are fairly wide. Friends, now the index section done, I come to the most popular aspect of this video. The 5 counters that are high beta, high impetus, where you take small exposure, wait for big price moves, and 5 stocks that are low beta, low impetus, where you take large exposure, wait for small price moves. Why the difference in strategy? Because different traders, different mindsets, different aptitudes, and therefore different game plans. So the high beta, high impetus stock list is led by Indus Tower at number 1, number 2 IRCTC, number 3 Idea, number 4 Wipro, number 5 Voltas. The low beta, low impetus stock list is led by Bandhan Bank at number 1, number 2 Adani Ports, number 3 ICICI General Insurance, number 4 L&T Finance, number 5 L&T itself, the flagship company. Now, friends, do remember that this hierarchy of stocks can change day to day because volatility is dynamic in nature and therefore it changes hour to hour rather than day to day. So connect with me on social media wherein I update all these aspects in a very simple manner which you can update yourself with on a day-to-day basis, end of the session, late in the evening. My contact coordinates of my social media accounts follow at the end of the video. Friends, if you liked what you saw, do click like on this video. Subscribe to my YouTube channel if you hadn't already done so. In the comment section, please let me know whether you like the work that we are doing on this YouTube channel and help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Also, in the description below this video are hyperlinks to my YouTube playlist on Equity Masters YouTube channel, wherein I put up a couple of ideas every week. Do subscribe to my playlist there. Also on offer is a free trading guide from Equity Master. The hyperlink is provided there itself. Do avail of this fantastic offer and help yourself trade better. I thank you for your patience in watching my video and being with me till we meet again in my next video. This is Vijay Bhambwani signing off. I wish you have a very profitable week ahead. Do take very good care of your trades. Remember, there are a few red flags in this week, so it's going to be a little challenging. All the best. Take care. Bye-bye.